Good morning, and thank you everybody for joining us today. Over the past year, because of COVID-19, we have seen devastating effects on our economy. We've seen high unemployment, lost growth. We've seen many businesses go out of business. Yet the destructive creative cycle of the American economy has always been one of its strengths. And for all the destruction we see a lot more creation that occurs. And what we wanted to talk about today is capital formation, because companies can only get started, businesses can only grow if they have the financing capabilities that they need to fuel their growth, and also if there are government policies in place that will help those companies to get started and then foster their ability to grow from small to large. That has always been a very important priority of the Chamber. And we've been proud to engage with members on the Hill on both sides of the aisle on these issues for many years. It's hard to believe it, but 9 years ago already, we saw the passage of the Jobs Act, which was instrumental in helping to arrest the decline of public companies in the United States and help to remove some of the regulatory impediments that were preventing businesses to go on that path of growth. While we normally talk about capital formation in the context of job creation, business creation, and wealth creation, it is also important to remember that but for the Jobs Act, we would not have the Moderna vaccine today. Because of the easier access to the public capital markets, they were able to acquire the financing they needed for their R&D that led to their COVID-19 vaccine. I'm proud that we are joined today by Senator Toomey, who is one of the key authors of the Jobs Act and worked with Senator Schumer, Senator Crapo, and others in getting that passed. Earlier this year, Senator Toomey requested insights from the business community and other stakeholders about capital formation policies. The CCMC submitted a comment letter to Senator Toomey, and today we issued an addendum with several other trades that highlight the work yet still to be done from our 2018 Joint Trades IPO report. We're looking forward to hearing, among other things, of what Senator Toomey has learned from his request on capital formation and what he plans to do with those comments and making this a priority on the Hill. So without further ado, I would like to introduce Senator Toomey and turn the floor over to him. Senator Toomey, good to have you with us today.
Hey, thanks very much, Tom. It's good to be with you. Thank you for the invitation to be here and to address a really important issue to me, which is capital formation. And let me say at the onset that I think the Chamber's Center for Capital Markets Competitiveness has been a very constructive voice, a helpful way that business can channel important thoughts to policymakers in Washington. And you, Tom, and your team have done a great job consistently reaching out and making persuasive arguments to members of Congress. I really appreciate the recent submission that you referred to with respect to capital formation at my request. That also has been very helpful. Let me also thank all the participants around the country who are on this call. And let me start by suggesting, I think America is poised for very strong economic growth, continued strong economic growth as we recover from this COVID disaster. But in order to maximize that growth, we need to retain our position as the leading capital markets in the world, the deepest, most efficient, most effective capital markets by far. That's a big part of our economic success. I think former chairman of the SEC, Jay Clayton, did a lot of good in this area, a lot of constructive work on capital formation. But I think he'd be the first to say there's still more work to be done. So today I wanted to touch on three areas in particular that I think are important opportunities for us. One is to try to continue to diminish the burden of being a public company. At the same time, I think there are ways that we can improve the market for private capital. And then finally, I think there are things we can do to enhance retail investors' access to investment opportunities. So these are the main reasons that I asked for proposals in these areas from stakeholders across the country. We did, in fact, get a tremendous response from that request. bipartisan, it was individuals, organizations. In total, I think we got 35 comment letters representing over 150 separate legislative ideas. And unsurprisingly, I think everybody felt that there are, in fact, things we can do to continue to improve the environment for capital formation. So let's discuss why some of these improvements are needed in these areas, and then I want to touch on some next steps in this project for me. So first, I made the point that there are things we can do to diminish the burden of being a public company. I still think in a number of ways it is unattractive for many to be public companies. Public companies face costs that are excessive in going public and staying public, and I worry that these costs discourage public offerings, and I worry that these costs could be increasing in the near future. Going public used to be a capital raising exercise, still is sometimes, but now it seems more often than not, IPOs are really a liquidity event for earlier investors rather than a capital raising event for growth. Tom pointed out that the Jobs Act probably arrested the decline in the numbers of public companies, but I would suggest that we're still at a level that's much lower than we used to be and perhaps could be. So back, at its peak in the 1990s, since its peak, I should say, the number of publicly traded companies is down 40%, despite the fact that we have a much, much larger economy today than we did in the 1990s. And that decrease in public companies hurts economic growth because it limits the avenues available to a company to raise capital. It also reduces investment opportunities for average Americans, retail investors, and others. In 2020, of course, we saw a significant uptick in the number of IPOs, but this may be just transitory, right? Especially a large number of SPACs are contributing to this number, and that could turn out to be a temporary phenomenon. I am concerned that companies may soon face an onslaught of new SEC mandated disclosures, disclosures that are not about the material financial circumstances of those companies, which are, of course, appropriate and necessary disclosures, but rather disclosures on climate change and political spending, board diversity, and other matters. In some cases, these would be quite costly to comply with. But I think the bigger problem is that it's part of an effort, right? These disclosures about things that are not financially material to the company, they're an effort to intimidate companies into doing something that is not necessarily in the shareholders' best interest, but rather it is meant to appease left-wing activists. Let's be honest, I think that's a big part of this. We saw kind of a preview of this with the Nasdaq's recent diversity proposal. And let me say, I'm a big fan of the Nasdaq. I just disagree on this particular proposal. And as you may recall, it was an idea, it's a submission they've made to the SEC to have permission to require companies listed on the Nasdaq to have at least one female and one LGBTQ or racially diverse, as they put it, board member. And if a company doesn't meet those quotas, then they have to explain why not. The Nasdaq submission even suggested that the SEC should consider imposing this mandate on all public exchanges, and I think even private companies. Now, the Nasdaq justifies this diversity quota by saying that racial or sexual preference diversity improves the profits for investors. That may or may not be true, but if it is, then companies wouldn't be needed to be mandated to do it. They would do so out of their own interest in serving their shareholders. And ironically, one of the most successful companies ever to be listed on the Nasdaq, Amazon, would not have met Nasdaq's quota. It's hard to believe that Amazon would have been more successful had they met this arbitrary quota. So let me be clear. I am certainly not in any way opposed to diversity on corporate boards. I just don't think that mandatory racial or sexual orientation quotas are the best way to do this. And I will be very concerned about the SEC imposing this requirement more broadly. And I think it would be one more element to discourage companies from going public. My Republican colleagues on the banking committee agreed with me, and we wrote the SEC with our concerns about the Nasdaq's proposal, that concern that it would interfere with the corporation's fiduciary duty to nominate simply the best board members, whoever they are. It also violates the concept of materiality, which is a really important threshold criteria for requiring disclosures. And as I say, ultimately, on the margin, I am concerned that it would discourage companies from going public. So it's an important example of what I'm talking about, of making it requiring having regulations that discourage companies from going public. There's also a whole push, as I'm sure you know, for extensive climate change related disclosures. And again, this isn't about whether or not climate change is happening. It's about whether or not it is the obligation of companies to disclose non-material facts about themselves or about the climate. The fact is, companies are already, under existing laws and regulation, already required to disclose all material information about their financial circumstances. So if climate change poses a material risk to a company, then they're already obligated to disclose this information. That's not what this push is about. What this is about is climate activists who have no fiduciary duty or interest in the company or its shareholders trying to impose their own climate agenda. Who knows what ultimate purpose they would use this information for, but it's not about serving shareholders. I think these are misguided efforts in the securities disclosure space, and frankly, they won't do much to achieve anybody's objectives. So, I mean, the short conclusion on this is that I think securities laws and regulations are not the appropriate vehicle for advancing social, cultural, and political goals. We have environmental laws and regulation. We have civil rights legislation. We have political spending laws on the books, as we should. But, you know, as we continue to address whether all of these legislations are adequate for the challenges that we face, we've got a process of weighing costs and benefits and making trade-offs and negotiating a political consensus about climate policy, about these other areas. Securities laws are not the place to try to do that. And the SEC is not accountable to the American people. It's our job as members of Congress to wrestle with these tough decisions and then make the decisions and be accountable to the people who elect us. I do, as I said earlier, I thought Chairman Clayton made real progress in this area in a number of ways. One was when he modernized the rules for shareholder proposals. The changes in his rule will reduce the abuse that some shareholder proposals by ESG activists have imposed, costs that raise the cost of being a public company. Unfortunately, our Democratic colleagues have introduced a CRA resolution, which is a mechanism by which they would rescind this rule. You know, they do want to use shareholder proposals and corporate processes to advance a liberal policy agenda. In many cases, it's an agenda that couldn't pass through Congress, so they want to use a different mechanism to do so. I think it would be a big mistake for us to repeal that rule, and I hope we will defeat the effort to do so. So as we are trying to diminish the burden of being a public company, I see no conflict in, at the same time, expanding access to the private markets. We should acknowledge, first of all, that private markets have grown much deeper, much more robust, and play a bigger role in our capital markets than they have. They've improved enormously over the last several decades, and more capital is available through the private markets than ever before. But there's still more that we can do, both from the point of view of the issuer and the investor. And I would reject the idea that we should resist improvements to the private markets so as to kind of force companies into the public markets. I don't think that either market is inherently superior to the other. Both markets serve different purposes at different times, and we should strive to maximize the ability of both private capital markets and the public markets to serve the needs of issuers and investors. Let me touch on retail investment opportunities, because this comes up in this context, right? One advantage of public companies is they create investment opportunities for investors. And as the pool of public companies shrinks, then retail investors are just cut out of key investment opportunities. One example is that average investors, of course, have very few opportunities to invest in private equity or venture capital. My view is we should expand retail investors' access to these non-public investments, allow them to diversify their portfolios, and get the higher returns that are sometimes available through these asset classes. We all know institutional investors and high net worth individuals routinely include private equity and venture capital and alternative investments as part of their diversified portfolios. Those investment opportunities should not be exclusively the domain of very wealthy or institutional investors. So as far as the next steps go, these are three areas of my focus in the category of capital formation. My team is still sifting through the proposals and ideas that we've received. And as I said, there are many of them, and many of them are very constructive. I'll be working with my colleagues, of course, on the banking committee, and I'm hoping that we can develop a bipartisan package of capital formation ideas. The legislation could promote private markets by, for instance, simplifying and improving the private offering framework, especially for startups. Could make it easier for private companies to find investors without being subject to onerous regulations. We could help public companies by streamlining their disclosure requirements, improving trading and research coverage for thinly traded securities, providing a longer eligibility period to be an emerging growth company under the Jobs Act. I think that has been the avenue for a very, very large percentage of new public issuance, and we could maybe expand that even more. And just generally ease the transition to going public. And then finally, for retail investors, I'd like to see us increase the opportunity for retail investors to access closed-end funds, for instance, and expand the definition of accredited investors. I think that definition is too narrow right now. So to conclude, let me just say I want to congratulate the recently confirmed SEC chairman, Gary Gensler. Gary is a very, very knowledgeable, thoughtful, and capable individual. I look forward to working with him on capital formation and other issues. One that I hope will be high on his agenda that I know he has an interest in is faster equity settlement cycles. I think that would be a very constructive development. And I think there will be other areas. There are areas where Chairman Gensler and I are going to disagree, but there are many areas where we can work together. And I hope that we will have, and I expect that we'll have a good, constructive working relationship and be able to get some good things done. So with that, Tom, thanks again for having me, and I'm happy to have a conversation with you.
Sure. Thank you, Senator. I think we have time for a couple of questions. Let me maybe pick up on towards the last points you were making there. You've obviously have received many submissions on your capital formation request. And one of the things I was struck by, right, is if you take a look at the Fortune 100 companies today, many of them were actually started during the 1975 recession, right? So, hopefully if we were to fast forward 25, 30 years from now, we'd say like, hey, look at those companies that got started, right, during the pandemic. So I guess my question is, in 2018, the Chamber, Nasdaq, a number of other associations, we put together the IPO task force report. Many of those suggestions were picked up actually in the Jobs Act 3.0, which passed the House on a bipartisan basis, didn't advance further, but then the Clayton SEC did act on a number of those things. Do you see a bipartisan consensus coming together on your efforts to pass legislation?
The honest short answer is I don't know, Tom. I hope so. I have a good personal rapport with Chairman Brown. He does see the world differently than the way I view it. The ultimate goal of this is to strengthen the American economy, create more opportunities. That leads to more jobs and a higher standard of living. So I would think we ought to be able to find some common ground. So I hope so, and I intend to work towards that goal.
And Senator, you also you're in a very unique position in the Senate, right? Not only from your position and your long tenure as on the banking committee, and also with your time in the House, but you are also very involved in the private sector, in the capital markets. You know what it needs to take for a business to go into the capital markets to get started. We've seen the rise of some different vehicles, some of which like SPACs that have actually been around for a while. We're actually seeing digital assets now being looked at a little more increasingly by the private sector. But there's a lot of public policy work that has to happen there. We released a report on that earlier, as well as some, the re-entry of retail investors into the stock markets. What do you think Congress's role should be with some of those vehicles?
Well, first of all, we should tread very, very carefully. I think the digital currencies, for instance, pose a fascinating development. I think innovation and technology generally are very, very good things, and I would not want to see us pass legislation or regulations that would stifle the growth of these things. But at some point, may have to think about defining things. At what point, if any, do some of these innovative instruments meet the definition of a security? Are they a currency? If so, what are the implications for our payment system? So I think we do need to think a little bit about the guardrails that keep the system safe, but I certainly want to make sure we continue to encourage the innovation. You pointed out, a crisis can lead to some remarkable and constructive innovation. I think that's happening all across financial services right now. One specific thing I alluded to that I think we could do is support the SEC in shortening the settlement time. I don't see any advantage of having multi-day settlement time, but generally we should tread very, very carefully before lest we impede innovation.
And then one last question, because I know, Senator, you're up against time, but obviously over the last year, we've had a lot of emergency measures come in, some of them necessary last March, in terms of helping to stabilize the financial markets and, actually to restart the private corporate bond markets as an example. But this also can have some impacts in terms of the pricing of capital and the flow of capital and the like. How do you see some of those issues playing out, and what do you think that you'll be doing in terms of your oversight role as to some of the banking regulators or other agencies with some of those issues?
Well, I think the most important thing that I've done in a while was late last year, making sure that the extraordinary 13.3 facilities that we funded through the CARES Act would come to an end. I mean, when you think about what we did in March, and I think it was the right thing to do, and I helped write that legislation and I supported it, but we provided $500 billion to capitalize a series of special purpose vehicles that the Fed could use to leverage up to several $1 trillion to provide a backstop for all of our capital markets, right? Commercial paper market, corporate bond market, the muni market, even to have the ability to directly lend to corporate America. That was meant to be a very, very brief response to a full-blown crisis, just to get the capital markets working again. It was not meant to be the mechanism by which we would have the federal government allocate credit. Now, we got into a big fight over this. Our colleagues on the other side of the aisle saw this as a great opportunity to control the allocation of credit. And so, my mission was to make sure these programs came to an end, because that's the last thing we want is, government-sponsored credit allocation. That's a big, I think that was a big win for our economy and for our capital markets. I'm still frankly concerned with some of what the Fed is doing. I mean, we have this very robust recovery underway, and yet the Fed, in addition to keeping interest rates at zero, negative real interest rates at the short end, the Fed is buying $1.4 trillion a year of securities. There's no way you can justify that in terms of the need of the economy. And so I'm concerned that distorts our fixed income market. Certainly that probably contributes to a rise in asset prices generally. And, we can have dislocations and distortions and bubbles arise if this sort of thing continues too long. So, I'm going to keep pushing the Fed with a lot of questions about what they're doing and why they're doing it, and when we're going to see a normalization of monetary policy.
Well, Senator, thank you very much. We appreciate the time you've given us today, and we look forward to working with you and the team further on these capital formation proposals as you put them together. So thank you very much.
Yeah, well, thanks for having me, and thanks for the great work that you do and the great working relationship we have, Tom.
Thank you. So we'd like to now move on with our program, and like to thank Senator Toomey. And speaking of job creation, we're going to be joined now by David Weeks, who's the Vice President and Head of East Coast Relationships with Nasdaq. Nasdaq has been an important partner with the Chamber on capital formation issues, particularly with the IPO task force report, as well as with various different proposals in terms of doing away with some impediments that prevented companies from going public, such as proxy advisory firm reforms, as well as shareholder proposal reforms. So without further ado, I'd like to have David join me for a little bit of a fireside chat. So David, good to see you. How's everything?
Great, Tom. How are you?
Good, good. So before we get into IPOs and capital formation and all that, I do just want to highlight some work that the Chamber and Nasdaq have done in the past, where the Chamber of Nasdaq have worked together for years in support of the Maloney-Meeks legislation on corporate board diversity that passed the House by a wide bipartisan margin in the last Congress to help facilitate board diversity, but through a business-led solution under the auspices of the SEC. So, one, I'd like to thank Nasdaq for their partnership with that and making sure that we can advance such a bipartisan effort on a business-led solution that also includes all other stakeholders as well.
Yeah, and I think the key there is it's so important from our perspective and from the listed company perspective for this to be a business-led solution. And we're just pleased to see the progress that we've made since announcing, our own board diversity proposal back in December, and how some companies are already incorporating it into their proxy metrics and disclosure regime. So more to come on that, but the feedback that we've gotten so far from the issuer community is overwhelmingly positive.
So David, let's talk about IPOs, right? So, when Senator Toomey and I were talking, and we talked a little bit about the Jobs Act, right? And how Senator Toomey is right. We've seen such a stark decline in the number of public companies since the mid 1990s. And while the Jobs Act, sort of stopped that decline, we've seen somewhat of an upswing, but that's actually been fairly recent. We both collaborated with a number of other organizations on the IPO task force report. But can you talk a little bit from the Nasdaq vantage point of what you're seeing from companies as they're deciding if they want to go public or not go public, or do an IPO? What is it that you're seeing from your vantage point?
Yeah, and when you think about it, Nasdaq really is the backbone of many of the world's markets, and one of our main responsibilities, and one that we certainly take seriously, is to help ensure that the capital markets operate fairly and efficiently for all market participants. So markets are definitely a fundamental part of the economy, and we have to continue to advance our rules, our capabilities, so more people can put their savings to work for long-term wealth creation, while at the same time really allowing people who have great ideas, raise capital, turn those ideas into businesses. And we feel that honestly, we owe that to our over 4,000 companies who have chosen to list on our exchange, and also to the institutional and retail investors who obviously provide the capital to help those businesses grow. And to your point, a lot of the momentum that we've seen in the IPO market is recent, and I'm sure we're going to get into that in a little bit. But we do also recognize that some companies choose not to go public or delay their path to public company life. And when we think about the reasons why companies might turn away from the public market, they can be complex, they can be wide-ranging, but the things that we heard and companies have concerns about are activism, shareholder litigation, the pressure of short-term returns over long-term strategic growth, and then obviously the burdensome costs, regulatory costs, just to name a few. And then once public, I think particularly smaller issues sometimes find the cost of accessing equity capital to fund their growth can be expensive, and really given the distributed nature of trading across markets and venues. So many times they seek private sources of capital. In today's environment, there's certainly an abundant supply of capital available. And then just lastly, some companies, I would say there is a delay just for the readiness of being a public company. So we are seeing companies delay the IPO as they try to put together a better public company team, while making sure that the process and procedures are in place to ensure success, once they do go public. So that could obviously include everything from the management team, CEO, CFO, but also extend to the boardroom, as companies really do want to make sure that their board, has the right experience and can guide them in the best possible way.
So can you talk a little bit about what you're seeing in terms of some of the changes in terms of the recent increase in IPOs? I think there's been a lot of focus about direct listings and SPACs, and certainly they're playing a role. They may not necessarily be the new innovations that people think they are, because they've been around for a little while, right? But can you maybe talk a little bit about that? But also, are there still structural impediments that you are seeing that prevent businesses from advancing to become public companies?
Sure. So let me quickly recap 2020, and it was truly a stellar year for the IPO market. So we had 471 companies raise $155 billion. So in order to kind of meet that mark, you'd have to go all the way back to 1999 for the previous record, when companies raised $108 billion. IPOs posted their biggest first day gains since 2000, which was 34% on average, compared with 65% in 2000. And SPACs accounted for 53% of the total number of deals and 49% of the total raise. So to your point, Tom, despite all the chatter into 2020 about direct listings, there was actually only 3 direct listings executed: Palantir, Asana, and Thrive Holdings. So 2020 was obviously the year of the SPAC, $75.5 billion raised through 248 SPACs. We saw that basically a 21% increase from 2015. And as we look ahead, I would say the expectations are definitely high. 2021 is off to an incredible start, with 425 IPOs raising over $130 billion. And here we are coming up to the end of April, and the IPO market, in 2021 is almost what we saw for all of 2020. And Nasdaq alone has listed this year, over 300 companies with just a little over 200 of them being SPACs, and our pipeline remains strong. But with that said, I do think about structural challenges that remain, and I would have to say that even though that we've had some strength in the past year and a half, I do think we have to be careful that public markets do remain accessible and aren't under pressure from increased regulatory burdens or public company costs. And I would say one area that we're definitely hearing more and more from our listed companies on is on the D&O insurance side. And our own experience is that we've seen our premiums increase 20% year over year. And quite honestly, many of the CFOs I talk to and CEOs would be happy with 20%. They're seeing 40, 50% increases in their D&O side. So I think while the highest increase obviously accrue to the largest companies, the increases for small to medium companies also come at a high cost, and it just drags, right? It drags on the company's abilities to invest in their business, research and development, and things that can grow value for shareholders. So what's interesting is companies are starting to seek support to revise the Delaware General Corporations Law to provide more flexibility and options for indemnification of corporate directors and officers. And I do think this is an area that you will continue to see focus on.
Yeah, and to be clear, right? I mean, for our audience, when you're talking about D&O insurance, we're talking about litigation, right? And that litigation is a real impediment to that, which we've been talking with the SEC about litigation reform in the securities context very broadly. One last question, because I know we're beginning to come up against some time here, but the Nasdaq released its blueprint to help with IPOs a year before the IPO task force report came out. And the Nasdaq Blueprint talked about one-size-fits-all policies that are an impediment to companies growing from small to large, but also talked about a number of different either rules that should be changed, like Reg NMS, or some different innovations in terms of venture capital exchanges. So could you talk a little bit about that, of maybe some things that you would like to see changed that could help with some of that diversification?
Yeah, absolutely. And let me start. I mean, my comments will focus really on what I would say is typically, smaller companies. But let me start by quoting Brett Redfern, who was former director, Division of Trading and Markets at the SEC. And at a market structure roundtable at Sandler O'Neill conference, he said, there's a boatload of stocks that don't trade very much. Why should they trade on 13 exchanges in pennies and microseconds? And that's a great question, and one that we're truly trying to solve for. So I think for small cap stocks in particular, there's definitely trading difficulty for this class. Stocks that don't trade much and cost a lot to trade when you do trade them. And what we find is that as market cap falls, stocks tend to get harder to trade. So liquidity declines, volatility increases, spreads increase. Those are all bad things from a company's cost of capital and from an investor perspective. So I would say two key areas that we're focused on. One, really stems from our revitalize effort, and there was engagement from the SEC and Congress, was the idea about issuer choice about the trading of their shares in the secondary market. So I think one of the unintended consequences of the current market structure is that these small and medium growth companies, and quite honestly, the investors that invest in them aren't receiving their proportional share of the benefits. So we think, modern markets need to be flexible. We recommend permitting issuers to kind of choose to trade in an environment with consolidated liquidity. So by creating a market for smaller issuers that is voluntary for issuers to join, and that is largely exempt from what we call UTP obligations or unlisted trading privileges, we can concentrate liquidity and actually reduce volatility and improve the trading experience. And why do we say that? We say that because we've seen this happen with the markets that we operate in the Nordics, and we see the benefits of that concentration. I think secondly, one of the things that, alluding to Brett's comment, was we think deploying intelligent tick sizes is something to be considered. So every company listed on a U.S. market trades with the same standard tick size. But when you think about where technology is, it really has made this unnecessary.
Great. Well, Dave,
so we believe that these.
No, go ahead. I'm sorry.
Oh, I was just going to say, we believe that these companies should have the ability to trade sub-penny, penny, nickel, even dime increments, and transparent, standardized methodologies that can be used to develop that optimal tick size. So I think both of those things could improve the trading outcomes for companies.
Great. Well, David, thank you for that. We appreciate that, and we appreciate our partnership and the work that we're doing with all of our partners in capital formation. We're looking to continue to push the ball forward. So thank you for joining us.
Yeah, and thank you for your participation, Tom, and your partnership. So thank you.
Great. And now let me turn it over to Evan Williams, our point person on capital formation and corporate governance.
Well, thanks, Tom, and thanks to Senator Toomey and David from Nasdaq for their enlightening discussions on this very important topic. I'm joined by Adam Rice, Head of Public Affairs at the American Securities Association, Justin Field, Senior Vice President of Government Affairs at the National Venture Capital Association, and Carlo Passeri, Director of Capital Markets and Financial Services Policy at the Biotechnology Innovation Organization. Let's just jump right in. Carlo, I want to start with you because I think the biotech industry has quite an interesting story to tell as it relates to IPOs in the pandemic. How did the biotech industry benefit from the 2012 Jobs Act, and what are the impacts that's had on society's ability to combat the pandemic? And sort of, moreover, what are some of the policy priorities for the biotech industry that can build on that success?
Yeah, well, first, thank you to the Chamber for hosting this event and highlighting this important topic, and to Senator Toomey for his leadership on the issue. Entrepreneurship just isn't easy. It's especially true in biotech, where the odds are against you from the very start. The vast majority of clinical trials fail under the weight of all that is not known about the nature of disease. And these entrepreneurs do it anyways. They fight against these odds, and they choose to take that 10 to 15-year journey of bringing science to patients, which costs billions of dollars to do. So whereas everyone always celebrates when a company rings the opening bell of a stock exchange, thinking that it's finally crossing the finish line, for biotechs is just one more step on that journey, one more time asking investors to fund their research. Yet the overwhelming majority of biotechs that list have no revenues when they IPO. So policies such as the Jobs Act are instrumental to their survival, during their first few years of being public. The emerging growth company extension and IPO on-ramp are utilized by almost every biotech company, particularly since 2012, when it was passed. And this includes companies such as Moderna, as Tom mentioned at the beginning. Moderna is a perfect example of the utility of these policies. They IPO'd in 2018 and launched as an EGC, and they benefited from the ability of being able to spend that $1 million or so that it takes for 404B compliance, and instead spend that money on advancing their mRNA platform. And thank God that they did, because we're all benefiting from that science today. And now that they have revenues, they've grown into an excellent enterprise with robust capabilities and the controls expected from such an important company. But it all started with that EGC exemption and the ability to conserve capital to fund critical research instead of filing paperwork. This is also why Bio supported the SEC's effort to implement a revenue test to qualify as a smaller reporting company. But we also think more can be done. such as raising the public float thresholds, which are rather arbitrary when you think about it, and penalize good companies for the capriciousness of traders. We also agree with all of Senator Toomey's recommendations, including the extension of the EGC exemption from 5 years to 10 years, because we think that would go a long way to continue helping capital formation efforts for the future Modernas of the world.
Thank you. I appreciate that. And Justin, to follow on, NVCA has called for a fix to the definition of a venture capital fund, particularly as it relates to investments in emerging growth companies. What does Congress or the SEC need to do to ensure that VC funds can continue to play their important role when it comes to investing in young companies?
Sure. Well, thanks for the question. Thanks for having me. Really appreciate our partnership or our ability to work together. Maybe I'll just follow up on a little bit something what Carlo was saying on Moderna, and then get into sort of the other side of this, which is the very early stage where we've seen some pressures and during the pandemic. Carlo made a really good point about Moderna, and I would even broaden that out as we think about, why is it important for companies to go public? You think about the history of innovation in the post-World War II economy. Well, semiconductors, for instance, right? IBM was the largest company in the world, tech company in the world, when Intel went public in, I think, 1974. Biotechnology. We had, pharmaceutical companies, Bristol Myers Squibb, et cetera, that have been around for 100 years when Genentech went public and became the first biotechnology company in the world. And so the point is that as you see this happening, innovation is driven by young companies being able to grow up and scale in the public markets. And I think one thing that we always want to make sure policymakers remember is that the choice between an acquisition and IPO, for what policymakers want to see, the IPO is incredibly important, including for a lot of progressive priorities. So I just want to echo that about what Carlo was saying. To your point on kind of where we see the VC definition and why it's so important now. Well, there's been a significant shift, obviously, in what we've seen in the pandemic. And one of the big consequences that has led out has been really early stage financing, sort of those first dollars into companies. The later stage companies have still been doing pretty well, as you can see from IPOs and from late stage financing rounds. But it's those couple folks in a room with an idea that are having the most challenges getting capital right now, because you can't have these in-person conversations, because it's harder to break into networks, et cetera. And so what we want to see change in the VC definition is the ability for VC funds to pick up the shares of those really early stage investors, say angel investors, seed stage investors, et cetera, so that they then have liquidity to provide to these companies to try to get over this barrier. Because we do think if we don't do something going forward, we're going to have a little bit of a hiccup going a few years down the road, because we don't have that pipeline of early seed stage companies coming through like we have in previous years.
Yeah, that sounds very important. Thank you for that perspective. And Adam, ASA has been very outspoken about the need to improve regulations for small public companies, particularly when it comes to market structure and research coverage. What are some of your main priorities to make sure that regulations are tailored for small issuers?
Yeah, that's right, Evan. And thanks again for the Chamber for organizing this event today. Really timely and very important topic. And it was really great to hear from Senator Toomey this morning. He's been a real champion in Congress for capital formation, for expanding economic freedom and economic opportunity. So it was really great to hear from him. And, our mission at the ASA is to promote investor trust and confidence, and to help small businesses access the U.S. capital markets to create jobs here in America. And so improving and modernizing these regulations for small public companies while incentivizing small business capital formation is really one of our biggest priorities. And, strong public markets are not only good for investors, but they're good for economic growth in this country. And they're particularly good for retail investors and retirement savers who depend on these strong public markets to help finance their retirement, send their kids to college, and save and invest for a better future. Not only have we seen a decline in public companies, but a lot of public companies are going public later in their life cycle. And this presents a real challenge because it makes it harder for retail investors to participate in that early success and have higher returns over that investment cycle. And what we're seeing is compliance costs continue to be an impediment, especially for small issuers. Right now, issuers spend an average of $2.5 million to complete an IPO. And that's not only one upfront cost, but it's a cost that they recur every year for over $1 million. And that's especially burdensome to smaller public companies. And research coverage also remains a problem. As we noted in that 2018 report, some 2/3 of companies below $100 million market cap don't have any research coverage at all. And this is leading to a big problem where we're having orphaned companies on our markets and exchanges. But at ASA, we think the Jobs Act and the emerging growth approach took a big step in the right direction and should be a real model for reforms going forward, as they have shown that rules can be tailored, in a smart way without impacting investor choice and investor confidence. And so we were happy to join with some of our partners here in submitting recommendations to Senator Toomey on his capital formation request. And just at a high level, some of our proposals include improving research coverage for pre-IPO and small public companies, advancing secondary market trading reforms, better scaling these regulatory requirements, especially for small issuers, taking a look at some of the short sales, especially the short and distort mechanisms that really can harm some of these emerging growth companies the most, as well as avoiding unnecessary loopholes to registration that lead to investor harm. So these are just some of the things that we think Congress and the SEC should prioritize as they move forward in the next package of the job cycle.
Yeah, thank you. CCMC also submitted, as we sort of alluded to before, also submitted comments to the senator's file. And Justin, I want to pick up on something that Adam just said, in sort of talking about both policy proposals, but also, what might be good for smaller public companies. When we talk about capital formation, we tend to inadvertently talk about coastal hubs. As we think about economic recovery from the pandemic, what are some of the items policymakers should prioritize to ensure economic growth is more evenly distributed, especially to non-coastal regions and to smaller companies?
Sure. I think it's a great point. I think it's one of the paramount questions that's trying to be asked in a number of different policy platforms in Washington today. I may not go through the list because my list would look very similarly to David and to the other panelists here in terms of the things that you need to do for small capitalization companies. What I would do is maybe back up a second and say, if you think about what these changes are trying to do, which is try to bring more companies into public markets, and in particular, more small capitalization companies in the public markets. We heard Senator Toomey talk about how the number of public companies is off 40% from the late 90s. And that's absolutely true. So when we look at, it's even worse if you look at the size of, if you look at it through a small company lens. That's really where you've seen the companies disappear. And, it's not that difficult, relatively speaking, to build $1 billion company in San Francisco, New York, or Boston. Building a company like that is the size which they can withstand the challenges of the public markets in a non-coastal area is really difficult. But in my view, if you look at like what the Endless Frontier Act is trying to do, for instance, if you look at what President Biden's innovation package is trying to do, which is trying to harness innovation to create economic opportunity in more regions across the country, an indicator of that success is going to be, are there more public companies 5 and 10 years from now? And are those public companies coming online in a more distributed fashion in Cleveland, in Austin, in Detroit, et cetera? And so, I think everything that's been said in terms of trying to create policy that can encourage more companies, especially small cap companies, to go public is going to be critical for the success of a lot of the programs that people are talking about and trying to expand the economic opportunity across the country.
That's really great. And, I think your point is very well made about the success of legislation being measured in, increased access to capital. You look at the 2012 Jobs Act, we're almost, a decade on from that piece of legislation. And, as we've already discussed, the benefits are very apparent and real. Sort of, Carlo, picking back up on that thread, I want to come back to you real quick. In 2018, the SEC adopted changes to the definition of a smaller reporting company that exempted low revenue companies from certain requirements, including some of the auditor attestation requirements of Sarbanes-Oxley. And this can be particularly impactful on the biotech industry, and your organization has been very involved in this issue for years. How should these changes help biotechs divert more resources into R&D and innovation as opposed to compliance costs?
Yeah, I think it's been critical. The vast majority of our members at Bio, have no revenues, and they fall within that sweet spot of being less than a 700 million public float company. So, for the long time, we struggled because we kept on having to spend this $1 million or so for compliance on this, and a couple of our chairs of the companies that belong to our chairman actually have tripped into 404B. Attestation this year, and they're having to spend again over $1 million. And these are their figures that they're quoting to us of the internal personnel and external consultants that they have to hire in order to do this, even though they still have no revenues. So it's a classic case for biotechnology companies that you're listed because you need to gain that 75 or $100 million, but everything is earmarked, and then all of a sudden you trigger these attestation requirements, and now you have to sort of spend money on this instead of spending money on research. And a lot of people will say, well, it's only $1 million, it's only $2 million, but in science, $2 million goes a very, very long way. That's a whole bunch of pipettes, that's a whole bunch of that's several personnel that you can hire to advance your research instead of having to file paperwork with the SEC. When investors in small biotechs, they're not necessarily waiting for your 10Qs. They're instead of waiting for their 8Ks, so the periodic updates on the science. At least if you're a long-term investor. If you're a short-term investor, you're paying attention to your 10Qs because you're trying to calculate cash burn rates and what's the cash runway and when's the next time you're going to have to do a follow-on issuance. So you can start planning when you start shorting the stock. We agreed and supported the SEC's move to insert that revenue test because it's, we thought that it was a gap in the existing rules, and we were very appreciative that they inserted that because it's really helped save a whole lot of money for our companies.
Well, if I remember anything from 11th grade chemistry, it's how fragile a pipette can be. So, Adam, maybe to close, we'll give you the $64,000 question. What do you think the outlook is from a congressional perspective for bipartisan agreement on capital formation issues?
Yeah, thanks, Evan. And I think we share Senator Toomey's optimism here. I mean, Congress has a real history of acting across party lines to advance capital formation. The Jobs Act passed with, close to 400 votes in the House and nearly 3/4 of the Senate supporting it. And as you can see here today, there continues to be support, among the industries here, the business community, and with champions like Senator Toomey in Congress. I think it has a really good path forward. One of the economic bright spots that we've seen since the onset of the pandemic has been a real surge in business startups. A recent study found that Americans created 4.4 million businesses last year, which was a 20% year-over-year increase. But the challenge is that these businesses are going to need capital if they're going to survive and contribute to the next wave of growth and innovation in this country. And I think that's going to be a real opportunity for Congress to build on the success of the Jobs Act, help more businesses access the capital market to grow and create jobs and help working class Americans and families, share in that success. So we're looking forward to working with all of you guys up here to achieve that.
Yeah, thank you. We're looking forward to partnering with your organization and with members of Congress to achieve more success along the lines of the Jobs Act as well. Well, we're at time. I want to thank our panelists for their participation today and once again flag that the private sector organizations participating in today's event have all co-signed an addendum to our 2018 IPO report, highlighting the unfinished policy work recommended in that report. You can find that addendum and all of CCMC's policy priorities on our website at centerforcapitalmarkets.com. And I'd like to again thank Senator Toomey, Nasdaq, the American Securities Association, the Biotechnology Innovation Organization, and the National Venture Capital Association for participating in today's event. And thanks to our audience who was able to tune in today. This concludes this morning's event.